Hi, my name is George Dagnino. I'm the editor of the Peter Duck portfolio. As I told you in the past, I spent my nights, I know this is crazy, but I like to see what people are saying. So I follow all the YouTube podcasts of financial analysts. And what I found is absolutely amazing. Everybody is pessimistic. Everybody is predicting the end of the world. Everybody is predicting a 40, 50% correction. Some people are predicting depression. And it is really incredible, incredible. I guess that kind of news sell. So what I thought to do today is let's look at some risk indicators, the ones that they seem to be the most reliable, and let's see what they are saying. It really time to worry and go to cash and sell everything, or it just be okay? Everything seems to be okay. Let's look at them. As you know, I don't like to talk about opinions. I like to look at the charts and see what the charts are saying, what the data are saying. This these two graphs represent the bond spreads between corporate bonds and treasuries. When the spreads rises like it happened here, like it happened here, like it happened here, it means that there is risk. These corporate bond yields are rising much faster relative to to treasury because people are concerned about the credit quality of the corporations. This what is also amazing, these curves like this match exactly the business cycle indicators that I show in my presentations. Exactly. When they rise, the economy is strengthening. When they decline, the economy, say the other way around. When they rise, the economy is weakening. When they decline, the economy is strengthening. So there are two different investment strategies, as I discussed in other videos, when business cycle indicators rise or declining. But again, the point is risk is rising, the economy is slowing down, risk declining, the economy strengthens, declining, the economy strengthens, rising, the economy weakens, declining, the economy strengthens. Right now, bond spreads are very low and they are not showing this kind of pattern like we saw in 2014 or 2011 12 or 2018 19. So this what this chart is saying is credit is okay. There is not risk perceived by the financial markets. This chart shows the credit spreads of low-grade bonds, not high-grade bonds as I showed you before. And as you can see, when the spreads decline, the market strengthens. When risks start rising because low-grade bonds yields start rising faster than the yields on the treasury, meaning that investors are becoming nervous about the markets and the credit conditions, the stock market declines. However, what you see now is credit spreads for low-grade bonds are declining quite sharply, as in August of last year, and that's as long as it happens. As you can see, the stock market is going up. There will be correction, of course, but as long as the credit spreads are declining, then the stage is set for a solid stock market advance. This chart shows the S&P 500 on the top panel. The lower panel shows the volatility index. Of course, you can expect volatility increase. That is, the market gets more nervous. Investors are getting nervous, so there's more price changes are becoming wilder and wider. And when instead volatility is low, the movement in price is smooth. So what you see here is that in the bottom panel, when the volatility index rises, the stock market declines because investors are becoming more nervous because of what they are seeing in the economy. Then volatility declines, usually below 20, and it's steady as you go. There could be minus bottoms and peaks and valleys, but the basic trend here is positive. When instead volatility increases again, because as we said, for instance, credit spreads are rising, then you can see the stock market declining. Right now, volatility is declining. Why? Because investors have become feeling more comfortable with the fact that credit spreads are declining and with the economic conditions. So this movement in volatility is bullish for the market, and as long as this continues, this trend should move. The trend of stock prices should move higher. That will be probably short-term correction, but as long as volatility goes down, the main trend is up. This chart shows the S&P 500 in a technical indicators. These are momentum indicators that I developed. And what they are saying is that when they are above this line here, the market is overbought and you should not expect a strong move ahead, but maybe a period of rest or maybe a small correction. So right now, these indicators are here at above, showing that the market is in the overbought territory. Of course, they could stay here for a long time, for that matter, but it's saying that the market is overbought. So you would not be surprised if there is some pause in the market. So right now, what am I saying? The risk indicators are all positive. The trend of the market is up because risk and volatility is declining and risk spreads are low. The market has reached some overbought conditions, so the rate of increase may be slower, but we should not panic just because the market is overbought. In other words, what I'm saying is the big correction of 30, 40, 50% with that level of credit spreads and volatility coming down is not anytime soon. I wrote this book because McGraw-Hill asked me to write a book on business cycles, and the title is Profiting in Bull Markets, in Bull or Bear Markets. It's been translated in several languages, especially in Asia, and I had some decent reviews. I'm very proud of them. So anyway, but this is my work. This is what I base all my work on. Peter Dack's Business Cycle Academy is based on this book. When you become a member of the Peter Dack Business Cycle Academy, of course, you can have several membership videos only like this one, videos and market updates, or membership number 3, where you have the Peter Dack portfolio twice a month, plus the videos, model portfolios, our trading systems, and market updates. Thank you for watching this video. I really do appreciate it. And if you want to know more about my work, please do visit www.patreon.com/Peter Dack. Again, thank you very, very much for following me. I really do appreciate it. See you very, very soon. So long.